This is Chad Toyne with a continued special report about Hong Kong from Trader PhD. Tomorrow, Friday, May 29, President Trump is to hold a press briefing discussing China. With the current social unrest in Hong Kong and the recent moves that China has taken to tighten its grip on the city, there is a high probability that Hong Kong could lose its special status as a semi-autonomous part of China. Please listen to the following special report that I produced for you guys back over a year ago. Keep in mind that this was released in late April of 2019. Afterwards, I'm going to come back and explain what actually happened to Hong Kong's economy over the past year and where recent events may lead us. So first, listen to this April 2019 special report. Back on March 20th, I mentioned to you guys during a broadcast that I wanted to give you guys a heads up on something significant that I'd been seeing develop in China concerning the Hong Kong dollar. It's a serious situation that's likely to come to a head in the third or fourth quarter, and it's going to have an impact on markets around the world. The Hong Kong dollar is pegged to the US dollar, but it's in trouble and something's got to happen. The basic problem is that Hong Kong is going to soon be forced to either defend its pegged currency or to raise interest rates. And this decision needs to be made before the Hong Kong Monetary Authority, the HKMA, runs out of excess reserves. And it's my belief that the HKMA does not have endless reserves. I'll explain that shortly. A little background here. The Hong Kong dollar has been pegged or fixed against the US dollar since 1983. And that rate is 7.8 Hong Kong dollars to the one US dollar. In 2005, the peg had been given a range of 7.75 to 7.85. That's a range of about 1.3%. So where's the Hong Kong dollar now? It has stayed on the strong side of the band for a long time, but now it's hit the weak side of the band. At 7.85, the HKMA is mandated to hold the peg, and they do that by buying up the Hong Kong dollars that are being sold in the marketplace and selling their US dollar reserves to do so. But they're running out of money. Since June 2017, the HKMA has burned through 71% of its $260 billion reserve by defending the weak side of the peg. At this rate, they're going to be running out of money by October. They got about 6 months left. So what do interest rates got to do with it? If one currency is pegged against another, you can choose to have your currency denominated in whichever pays the best interest. Your Hong Kong dollars in a Hong Kong bank can pay you about 1% interest, or you get about a 2% rate on your US dollars in a US Treasury bill. No wonder people are selling their Hong Kong dollars and buying US dollars. And now the Hong Kong dollar is pushing the weak side and it's in trouble. So why doesn't Hong Kong just raise interest rates? They've had an uptick in rates just here recently, but Hong Kong can't handle higher interest rates. Hong Kong real estate prices have exploded since 2003, up between 400% and 600%. But just in the past few months, real estate has had a downturn right at the same time that interest rates have edged up. So not only is it a real estate bubble, it's a credit crisis in the making. The people of Hong Kong have borrowed an incredible amount of cheap money to buy real estate, and it's all subject to the changes in their interest rate. The amount of public debt that Hong Kong has put into real estate is twice that of the United States, and that's an incredible amount of money. And we all know what can happen when banks lend people a lot of cheap, easy money to buy homes, and then the interest rates on their mortgages go up. That's what happened in the United States during our credit crisis of 2008. A little bump up in Hong Kong interest rates, and soon there's going to be a mortgage default problem, a crashing real estate market over there, and the Hong Kong banks are going to get left holding the bag. The banks are going to stop lending money to other banks, let alone anybody else, and a credit crisis ensues. And then they're going to have a serious problem. An Asian banking crisis is going to send major ripples through the world financial markets. It's my belief that there is a quiet panic already going on in Hong Kong. Why doesn't mainland China just write them a check? Well, this is what I was talking about when I said that there is not an endless reserve for them to work with. Hong Kong used to be super important to China. It used to be 25% of China's GDP back in 1993, and today it's only 4%. Mainland China can let Hong Kong fail. And the attitude that mainland China has towards Hong Kong, it's a cold relationship. So here's a little history lesson. Back in the 1800s, China was forced to cede Hong Kong Island to Great Britain. And in 1898, Britain signed a 99-year lease with China. And that lease ended in 1997, at which time Britain returned Hong Kong to China as a special administrative region. And now they have a doctrine that is of one country, two systems. Mainland China is communist, while Hong Kong has a limited democracy. The corrupt powers that be in mainland China would love to see Hong Kong lose their stronghold in order to gain more power and economic influence. What would realigning the peg mean? If Hong Kong realigns the peg, or it lets the currency float in order to entice foreigners to buy their extremely overpriced real estate, that's going to trigger social unrest. And if you keep the peg, you've got a real estate crash and social unrest. So either way, Hong Kong is going to be in some social turmoil within the next 2 years. So what's happened in the past? Are there any clues there? Hong Kong has had to defend the peg before, back in the 1990s, and that caused interest rates to explode, as high as 20%. Such a reaction today would be an economic disaster. So in short, there's no easy way out for them. You can't be over-leveraged in a bubble market that depends on low interest rates, with nothing but a dwindling reserve to keep it from collapsing. At the rate that they're going through the reserve, we could see financial crisis headlines coming out of Hong Kong. So be aware of your investments when you see financial headlines about Hong Kong. Now you know that something like this is likely to happen. I'm not telling you to pull your money out of stocks, but I am saying that you'll be much more likely to step aside if you start seeing the stock market start to have some trouble, and the nightly news keeps talking about some confusing gibberish about something going on in Hong Kong. You'll see this coming, and maybe you'll have the confidence to step aside. Well, what about opportunity? Well, so the Hong Kong dollar is likely to fall when the peg is dropped, or Hong Kong interest rates are likely to explode. So why not do something like go long the HIBOR, the Hong Kong Interbank Overnight Rate? If you get a futures account and you trade at the Hong Kong exchange, I suppose you can, but you'd have to convert your US dollars into Hong Kong dollars to fund your account, and that wouldn't be a good deal. The big boys deal with an investment bank to basically buy put options against the Hong Kong dollar. Banks like Goldman Sachs or Mortgage Stanley, they can structure obligations in such a way that they can trade these among each other. And remember during the credit crisis that they were trading the CDOs, those collateralized debt obligations? Those weren't for you and me to buy or sell on some open market like some shares of stock, but those are everyday instruments that they trade among themselves to manage complex risk. So if you have a connection with an investment bank and you can put up a very substantial block of capital, they can accommodate your request for a hedge against a Hong Kong dollar collapse. After our special report on the Hong Kong dollar was released back in April of 2019, Hong Kong had the annual Human Rights Rally held 2 months later, boasted a record turnout of 250,000 protesting the extradition bill that mainland China was trying to get passed in Hong Kong. People quit going to work. People quit spending money, and the economy sank. The surging real estate and banking crisis that I spelled out for you in the special report never happened. Instead, with the economy down, mainland China had a bigger problem: social unrest. Then came the COVID lockdown. That got protesters off the street, at least for a while. But now with the lockdown opening back up, protesters are back in the streets, and this time, mainland China is fighting for control. If, as expected, Trump withdraws Hong Kong's special status, that will set the stage for a whole new level of trade negotiations. Hong Kong will no longer be treated any differently than dealing with Shanghai. A new season will emerge with what it means to deal with China, both politically and economically. Thanks for listening. I'm Chad Toyne, and this has been Trader PhD.